Laura, and I guess the other big question is, are the price cuts coming here?
Hi. No, the price cuts aren't coming here, I don't think, but it does tell you that Netflix is having to resort to price to compete. So their long espoused theory that content is all they need to compete is wrong. There's they're either other local players or U.S. streaming players that are out competing them offshore. So they're having to lower price because that's their last option in order to drive sub growth.
And what does that tell you? Is it usually we think of price cuts as a desperation move, but sometimes they can be a sign of strength. For instance, Tesla's price cuts could be seen as taking out competitors as the cost of capital rises. How would you interpret this move by Netflix?
Well, maybe, but every streaming competitor here really has very deep pockets and deeper than Netflix in almost every case. Disney has sister subsidiaries from theme parks that are like record high margins that are funding Disney streaming losses. Similar with Warner Brothers, we just saw yesterday. You know, a lot of these bigger companies have streaming. Like Netflix can't put these guys out of business by lowering its price. These other companies are bigger than it. They can put Netflix out of business by lowering price, but this to me is a fool's errand in terms of a competitive strategy for Netflix specifically.
So they need something like the parks, or with Warner Brothers, we'll get to that in a second, like video games. I mean, what could be that kind of consistent cash flow generative asset for them?
They would have to buy something because today they're singles, you know, they're building games, but games is a money loser too. So they're a single line business, which loses a lot of money. So, you know, like they're also competing, by the way, with Apple and Amazon. Like nobody, like you can't actually win on price competition against Apple and Amazon because their sisters, their core businesses are so big.
Okay, so finally, I mean, and listen, I'm not a huge Netflix watcher, but I'm going to be watching the Mahomes, this football thing. I love it, okay? So how, if we look ahead to 2023 and we say, okay, is the stock going to generally be benefiting from price, retention, you know, new series that are driving engagement, and maybe even this price cut in other markets? I mean, or are we going to be telling ourselves a different story in a couple months' time?
So there's a new film coming out, looks great, on the beginning of Nike and how they bet on this unnamed guy named Michael Jordan and how they built the company on him. That's what Netflix is doing. Remember this huge documentary they had with the Princes, you know, the UK drama?
Yep.
So aligned with the book. Here we're doing that again, like they had the Obamas on. So they're paying for celebrities. It's a smart idea what they're doing. They don't want to go in for NFL rights, so they're going to pay some of these celebrity talents to do documentaries, and that brings a lot of fandom from that NFL at a lower cost to Netflix. That's a smart idea because they have no sports, and now they're in sports. So that's a smart idea in a low-cost kind of way, but it's also celebrity-based. And as you know from watching these YouTube stars, you know, these are human beings, and sometimes they make mistakes, and it destroys your brand, meaning Netflix, if one of these guys does something bad. So it's a risky strategy to depend on celebrities to drive.
You just make a movie about that. You just go, great, you guys are just churning out content. No, I'm kidding, but you still, let me put a period on it, believe that this year's estimates and valuations are too high for Netflix. So let me turn to Warner Brothers Discovery. Everyone talking about this last week, Laura, are they the new Disney? That's a big leap, but do you think David Zaslav can pull it off?
So it's a good question. I mean, I think when you buy an asset from AT&T, it is messed up. And we have a world-class chief financial officer here. Whatever he tells you he's going to do in cost cutting, he'll do more because he bought it from AT&T, and they are not good with costs, in my opinion. So I would say I think the strategy as espoused is good. It is a Disney strategy, franchise films, everything integrated. We're going to bundle HBO with Discovery, but we're going to let them be separate also. Like, that's smart. Like, everything they're saying, which is like a Disney-esque commercial. And let's remember, John Malone's on the board here.
True.
So we've got world-class businessmen in this company now, running this company. Let's not underestimate that over a 3-year frame. This year, I think it's going to be sort of tumultuous as they build back that film. And they ultimately have to execute. That's right. The issue. They have not been Marvel, and they need to be Marvel for that $5 billion film budget. And so as an investor, what do you think the potential here is for valuation? And again, how long do I have to wait? And I'm going to be waiting through what could be a recession, you know, very high cost of capital, possibly some M&A. Yeah, I think it's too early. We have a hold here. I think it's too early. I think what they're saying is right. Let's see how they execute, right? Because remember, when you build a film a film slate, you invest for 3 years. The first dollar of revenue is 3 years later, and he's building a film slate this year. That means your return on capital from a free cash flow point of view are falling. Still too early, but really like what he's saying. Let's see if they can execute that strategy.
Yeah, and if so, it would be one of the greatest stories. Netflix should buy that story. If he pulls it off, that would be one of the greatest stories of all time. Laura, thanks so much for your time today.
Thank you.
Laura Martin with Needham.